Are we on the verge of a massive foreclosure wave? Stay tuned. Thanks for watching. I'm Shirley with Shirley's Real Estate Group at John L. Scott. I've been helping clients across the Puget Sound for over 27 years, and this is the show where we talk real. Buying and selling real estate, that is. In our last video, we talked about pricing strategy, but today we're shifting gears to a topic that's been dominating the news, the rise in foreclosures. I get asked at least once or twice a week, if not more, with the rise in inventory, is the bottom gonna fall out like it did in 2008? Let's go over the actual numbers, so let's jump right in. Foreclosure activity is rising across the country, and this headline can sound incredibly scary when you hear them on the news. But this is also a prime example of where the media can get a little misleading. Sometimes the story is framed just to grab your attention without giving you the full picture. This chart from Adam, a national real estate data company that provides property, mortgage, foreclosure, neighborhood, and real estate market data, shows properties with foreclosure filings over the last several quarters. Starting back in late 2024, you can see the number has been gradually moving up. By the first quarter of this year, foreclosure filings were getting close to 120,000. So yes, foreclosure activity is rising. That part of the headline is true, but here's a crucial thing to understand. A foreclosure filing doesn't automatically mean a home will actually be foreclosed on. A filing is simply the very beginning of a long process. Many homeowners are able to catch up on payments, sell the home, work out a modification with their lender, or find another solution long before it ever becomes a complete foreclosure. And when we compare today's market to what happened during the 2008 housing crash, it's a completely different picture. Last year, we saw just over 300,000 foreclosure filings in the entire country. To put that number in perspective, during the 2008 housing crash, there are roughly 9 million distressed transactions when you count foreclosures, short sales, and deed in lieu. So while foreclosure activity is absolutely something we should keep an eye on, this doesn't mean we're headed back to 2008. Another chart from Adam that goes all the way back to 2005, you can clearly see the massive spike during the 2008 crisis. Filings shot up dramatically and stayed elevated for years. That was completely a different housing market. During the pandemic, foreclosure activity dropped to almost nothing. A big part of that was due to government protections, moratoriums, and delayed proceedings. Now, as the market continues to normalize, we're naturally seeing those filings move back up. But when you compare today's numbers to 2008, we're still nowhere near those extreme levels. According to Rob, CEO of Adam, while volumes remain below historical peaks, the continued rise, especially in starts and bank repossessions, suggests financial pressure may be building for some homeowners and could signal shifting housing market dynamics. And even a survey that was done by Credit Karma, more than 3 in 4 Americans, 78%, report that they don't feel financially secure. The culprit is the rising cost of living, followed by the current state of the economy, 42%. But look at how that pressure is actually being managed. This chart from the Federal Reserve Bank of New York shows the percentage of loans that are 90 days or more delinquent, going all the way back to 2003. When you compare different types of debt like credit cards, auto loans, student loans, HELOCs, and mortgages, one thing stands out immediately. Credit card delinquencies are high and other debt categories have moved around quite a bit. But look down near the very bottom of this chart, the green line. Mortgage and HELOC delinquencies are still incredibly low compared to everything else. That tells us something really important. Even when homeowners are feeling the pinch, they are prioritizing their mortgage payments above all else. They might let a credit card payment go late or fall behind on another loan, but the mortgage is the one payment that they protect at all costs. And that makes sense. A lot of homeowners have built up a massive amount of equity over the last few years, and many are locked into historical low mortgage rates that they don't want to lose. Plus, nobody wants to risk losing their home. So while filings are up, homeowners are taking their housing debt seriously, which is a very positive sign for the overall market stability. Here's another quote from Adam. Properties foreclosed in Q1 of 2026 had been in the foreclosure process for an average of 577 days. This was down 3% from the previous quarter and 14% from the same time last year, marking 6 consecutive quarters of decline. And the final piece of the puzzle keeping our market stable is equity. A vast majority of homeowners are sitting on a tremendous cushion right now. This chart shows that 39.3% of homeowners own their homes completely free and clear, no mortgage whatsoever. On top of that, another 27.1% have a mortgage but hold more than 50% equity in their home. When you combine those two stats, roughly 2/3 of all homeowners either have their homes paid off or have at least 50% equity built up. So question, do you still think after seeing these numbers that 2008 is going to occur all over again? Let me know your thoughts in the comments below. As always, thank you for watching. Don't forget to like and subscribe. Until next time, keep dreaming big and aiming high.